it's only going to be focusing on a NASDAQ. What I said about the dollar index, you can look at your chart and see it has done that. And then Eurodollar and cable have done as well. Higher dollar is what we were looking for. Weekly chart here, you can see that up here. I'm noting the volume imbalance right there. And I just included some narration to narrate the underlying bullish order flow that we were looking for. Bullish fair value gap here as well, traded down into that. You'll see this appear in the lower time frame charts. And we have this big down close candle here. That's the bullish order block. The change in the state of delivery is the opening price. And you can see how we dropped down into that here last week. And then we started trading here and moved up into that volume imbalance into the daily chart. And I graded the premium wick of the highest candlestick here. And that same weekly volume imbalance is being highlighted here. Interesting to see how the bodies are respecting that. And we dropped all the way down into this discount wick. And notice that we couldn't get to the upper quadrant before we came all the way back up. So that's usually indicative of strength. And we traded right back up into that volume imbalance. And the bodies have stopped dead in its tracks right there. So I graded this premium wick as well. You can see how they used that so far for today. Drop down into an hourly chart. And we have a buy side here, sell side, which was taken right below there. Just a small little drop down into a bullish fair value gap, traded right to the top of that. And notice it didn't get to the upper quadrant of that daily wick as indicated here, right there. Okay, so notice the price. That's this level here. And it fell just short of reaching into it, but it hit the top of the fair value gap here on the hourly chart. So what we're doing is we're looking at the price continuum from higher time frame down to lower time frame. You can measure the importance of the PD array's effectiveness in terms of providing discount or resistance, okay, or it cause and effect, if you will, of how fast it should repel from price. So we have discount sensitivity and we have premium sensitivity. The PD arrays need to be measured that way. You're measuring its inability to even trade to a specific level and staying within an underlying narrative. So we traded down into sell side, but we couldn't even get into the quadrant of that daily at this price range here. And then we started propelling higher. Then we have a new week opening gap high and low. And then previous week is here. And we traded right up into that daily volume imbalance and moving into a 15-minute time frame. So we have a buy side liquidity pool here on an intermediate term basis. And then we have sell side resting right below here. And then we have this new week opening gap. I graded that. So we've had a couple attempts to trade higher in here. How we use this volume imbalance for the remainder of this week will be indicative of what we do going forward. So if we can manage to get to the upside of it and then defend the upper half and never trade back to the lower half of it, that's bullish. If we break down to the low of it and then defend the lower half and trade no higher than the halfway point of this imbalance that's shaded in white, that daily and weekly volume imbalances, that's what this white rectangle highlighting is. That's what I'm using for the bias, determination for the rest of the week. Today's an election day or something to that effect, I think. So it's going to impact the volume that's coming into our trading day. We're down to a 5-minute chart. You can see we spent a little bit of time outside that volume imbalance on the lower time frames. It's normal to see that type of thing. We broke lower and then look at the sensitivity here. That's premium sensitivity in the upper quadrant, drawn back down to the midpoint of that, and then moving back down into the lower half to the low. And then if we can manage to do that, here is sell side resting here, 25,455, a good approximation. So that's where the daily sell side and the buy side on the daily boundaries would be up here. So those are the two daily extremes that I would look at. And I want to determine, as price is trading today, what is it more likely to draw towards? And what does that mean? Well, if we start making lower runs, then it might want to run and take up these sellovers here. If we move to the upside, then my focus would be not just simply getting above here, but drawing up to here. It need not do it all in the same day today, but it's just helping me frame modularly what the bias should be. I've been away from the markets for a couple weeks now. So when I do those types of things, when I go away or spend time away or after a holiday, a long break, like I'm getting ready to do. Okay, and here's the 1-minute chart. This is kind of like the lecture, the teaching. So I'm going to be teaching my kids sessions today, session trading. So it's not dependent on daily bias. It's not dependent on weekly bias. It's not dependent on anything except for what's available in the marketplace right now based on time and price. But if you're trading London, one of the things you want to do is develop an understanding of the opening range. And the opening range for that is 1:30 in the morning to 2 o'clock in the morning. And when we have that indicated, we can look left and you'll see that we have high, and right before 1:30, we have relative equal highs. So what's going to be above that? Buy side. But we start at 130 and then we rotate lower and draw back down to a lower discount. The first presented fair value gap here during that 1:30 a.m. to 2 o'clock in the morning is my gift to the community, because algorithmically, this is what price is looking at. If you're trying to trade London session, if you want to trade London open kill zone, if it's trading during this time, it's going to use this logic. Now, differentiating first presented fair value gap when we're using opening ranges, not the silver bullet. Silver bullet's like the first one that forms after 10 o'clock, inside that 10 o'clock to 11 o'clock in the morning hour. When I taught that, that's very generic. But when we're using opening ranges, you want to look at displacement. Okay, so displacement is the division from what everybody thinks they know about. Why wouldn't I look at that gap right there and call that the first presented fair value gap? Because if you take a look at that swing low right there, after we've taken buy side, as we're entering the opening range, we took buy side and then it displaces. So that fair value gap here hasn't even taken out that low, but this gap engages that low. It's laying inside of the proximity of that low liquidity. So it changes market structure, bearish. And now we can use this inefficiency to inefficiency, which is what? Suspension block. Now this first presented fair value gap is a bearish suspension block, and it reacts and respects the equilibrium point of it, which is classified as a consequent encroachment because it's a gap, it's an inefficiency. It's not a single candlestick like an order block. It's being viewed as a inefficiency because it's got a volume imbalance to the high end of it and the low end of it. So it's the distinction between the displacement drawing the importance to that individual imbalance. It's not just simply, well, there's one right here, so why didn't he use that? Well, the logic is simply what I'm teaching you here. There has to be some kind of basis as to why that imbalance should be used. And it's because we have shifted market structure lower after buy side taken. And this is what I'm referring to. Having this imbalance here because it's tethered to that shift in market structure. It's laying across that. You see that? So there's no necessity for price to get back up here. If the market goes up there, I'm not interested. I want to see that stay open as a breakaway gap. But the first presented fair value gap here is the tradable, executable PD array. And you qualify and confirm that by what I'm saying here. The displacement inside the opening range of 30 minutes before 2 o'clock in the morning, the same application is done with 9:30 to 10 o'clock in the morning. The same approach is being used there. Now, I'm going to take it one step further. This imbalance here, it's the first candle in the opening range. If it's bearish and it's a buy side imbalance, sell side efficiency, this will act as 90% of the time, that's going to be an inversion fair value gap that's bearish. Why? Buy side's been taken. It starts the opening range of 30 minutes. It's an imbalance and price rolls back over top of it. It should stop at the consequent encroachment level and not leave any bodies on the upside of it. And it doesn't even get close to it here and leaves the upper half untouched, trades into it here, gives you one more little kiss here, goodbye, and off to the races it goes. So what did I just teach you here? I taught you how to use the opening range for a London session. I taught you how to use the opening range for 9:30 to 10 o'clock in the morning when you're trading indices. And by applying this idea of, was there liquidity taken? You can clearly see that here. It runs above it. It absorbs all that. It throws down a fake bull flag. That's a false bull flag, and it breaks down. And then you can trade into the inversion fair value gap. It hits it beautifully here, and it starts drawing down to the sell side here, down to the consequent encroachment of the higher time frame ranges that we graded, and then created a sell side liquidity pool here. And now we're entering another time window. It's the what? The New York open kill zone. So the New York open kill zone is what? 7 o'clock in the morning to 9 o'clock in the morning, or 10 o'clock in the morning if you're trading Forex. Now here's a small, simple little caveat here. Okay. At 7 o'clock in the morning, I use the information I get from 6:30. If you remember back when I was doing paid mentorship, for those that were a part of that, in the lectures, I would always refer to how I would get up in the morning. The questions would come by way of, what's my routine in the morning? When I was trading Forex, I would get up in the morning. If I didn't trade London, I'd get up at least by 6:30 and get a feel for what the market was done. What does that look like? And what do I mean by that? Well, just be mindful that this is the low with sell side, and we had this retracement here. What just took place? Buy side, with this run up in here. So now we're going to go to the next slide. Here's that same sell side here. Now at 7 o'clock in the morning, go back to 6:30. What took place? 6:30, we had buy side taken. They've rated buy side. They've left sell side intact. All part of a larger draw on liquidity that's being pulled lower across all the higher time frames. So if that's the case, we can now look at, now here's the caveat for New York. Okay, why am I showing you 7 o'clock to 7:30 and not 6:30 to 7? Because I'm encompassing all of the assets. Okay, and to make that streamline, you use 7 o'clock because that's when all the algorithms fire up. There's not one algorithm that runs everything, but every instrument is ran algorithmically, and it's ran by a price engine that is completely and utterly controlling price. They come online basically at 7 o'clock in the morning. And then what you want to do is look at the reference points that I teach with my PD arrays within the context of the narrative, meaning what did it do at 6:30? Well, at 6:30, it took buy side. It's pulled down into sell side, and it left this sell side liquidity pool, but all these buy side liquidity pools here was rated air. We broke lower. These relative equal lows were taken, and then we traded right back up. Did that high take out that high? No. It traded right inside this wick. Grade that and see what that gives you here. And then we entered the 7 o'clock to 7:30 opening range for New York open kill zone, encompassing, you name it. This is the way you can do it, where it's a general approach to doing it. It's the only kill zone that you apply it this way. Everything else is 30 minutes before. The market runs up, creates a high, and then one more time rallies and takes out that buy side that's created there. So this is engineered liquidity. And then we have a shift in market structure below that swing low right there. This gap right there, this entire thing here, that has to be incorporated with this low because it's tethered to that. This low that's being shifted with a bearish movement in price, this bearish fair value gap, midpoint, consequent encroachment, the body stops dead in its tracks below it. It's allowed to wick a little bit above it, but then it comes right back down, gives it one more kiss here, and then runs aggressively down to the sell side. Notice that the mechanics are simply this. The run for the buy side, when you're looking for directional runs that are high probability, low resistance liquidity runs, not high resistance liquidity runs, low resistance liquidity runs always have an opposing run in direction before it happens. Meaning, if you're bearish, there has to be some measure of buy side taken before you enter the trade. You have to have that. In this case, we see it here. It rallies and then rallies one more time. That's a turtle soup. So the New York open kill zone, it's a little bit of a different animal versus London or the equities opening range at 9:30 in the morning to 10 o'clock. This one here is a little bit more quirky because you have to allow for all the different instruments that are traded at this time of day. I mean, think about it. London, Germany, Europe, they're all still up. It's like their lunchtime. United States, the lazy folks that are here, they don't want to get up and trade London. They're going to come up and they'll trade session like this. So they get active, and these algorithms will fire up and draw in through ignorance their participation for liquidity purposes. They'll use them for that purpose, and they end up getting beat up. And one or two things happen. They don't trade the rest of the morning if they're smart. They just go and heal, or they go in and try to revenge trade during the highest volume, which is 9:30 in the morning to 10:30 in the morning during the equities open. And they usually revenge trade there and blow their accounts or feed smart money even more. By having this perspective of knowing what the opening ranges are and how to use them effectively, that's what I'm showcasing here. So you can see it's beautifully illustrated here, drops down and draws into the liquidity there. Incidentally, back on October 30th, I gave you a tweet on October 30th, 2025. Might be time to take some profits in NQ. If you look at how it's anchored, it's here and it goes right to that candlestick. It's the highest one. On intraday, on a 1 minute chart, that's where the tweet was posted right there. It's not coincidence that as I did that, we were trading at the consequent encroachment of that wick that formed from the opening to the highest high that day. If you know what you're doing, you can do it intraday before the day even closes. So everything at that price level here, price should no longer want to explore the upper half of that. And the market shows wild displacement lower. They come back right here, gives you false hope. And then Elvis left the building and we traded down all the way down to this 24,700s. But we were up here. So that's a pretty significant drop. All I'm trying to do is protect you. When I talk about things like this, they're huge warning signs, okay? To just be mindful of it because they're not small moves that are coming. I'm not talking about a 200-point move, a 300-point move. They're significant price runs. I told you the same thing with gold. This is something that experience gains over time doing it. There isn't anything in particular that stands out as any. It's just because of my experience. When I look at social media, when I see the cowboy up mentality, they can't do anything wrong. They're making so much money. It's going to keep going higher. When everybody gets opinionated, one-sided, and all the focus is on a market, one individual market, you're really close to an important high. Knowing that and then applying it to the things I'm teaching you here with all the details with premium discount, consequent encroachment, equilibrium ideas, and how the daily candles form, like we're seeing here. All of this was done on the actual high candle after it took the previous day's high out. That's what you're seeing. A run above the previous day's high, down goes. That's how gold topped too. It took out the previous day's high, false breakout, dropped down a lot. And if you bought up there and held on to that, man, you got murdered. So when I post these types of things, okay, I don't want to come back and say, see how smart I was? I want to be able to hear, wow, I really could have got hurt. And I'm glad I took ownership of what I was doing and managed my risk better than I would have if I wouldn't have seen that warning sign. That's what I'm doing it for. Okay. That's what I'm trying. I'm trying to protect you, not make you rich. I'm trying to protect you because if you stay in this long enough, you'll learn what I'm teaching is the best. It's the best thing that you could ever have, the best way of looking at the price action, and you will be able to do whatever you want to do as a trader. And you won't care about anything else I teach because once you find your model, you'll bloom where you're planted.